Hey business warriors, Business Shifu here, and today we are giving you a step-by-step guide how to invest like Warren Buffett, okay? And we will give a couple of examples later in the video and a case study right at the end, so stay tuned for that. But first of all, let's talk about who Warren Buffett is. Warren Buffett is known as the Oracle of Omaha. He comes from Omaha, Nebraska, that's where he lives. And he has a net worth of $80 billion, which makes him one of the top 3 richest people in the world right now as of July 2019. Buffett serves as the chairman and CEO of Berkshire Hathaway, a company he took control of back in the 1960s, where he began a process of transformation. And Berkshire Hathaway now has a market capitalization of $480 billion US, which makes it one of the largest companies in the world. So Buffett's story started when he was just 11 years old. He purchased his first stock when he was working in a grocery store with his grandpa in Omaha, Nebraska. By the time he was 15, he had a net worth of $6,000, which was worth a lot more then than it is now. And then he grew his wealth over the 70 plus years of his investing career to $80 billion. So that's 6,000 to 80 billion. And thus he is often referred to as the most successful investor of all time. I'm going to show you a graph on screen now just how fast and how much Berkshire Hathaway has grown. Okay, so on this graph, the purple line is Berkshire Hathaway and the green line is the S&P 500, the stock market of Standard & Poor's 500, which is the US's 500 largest corporations. So from 1965 to 2018, Warren Buffett's company, Berkshire Hathaway, has returned about 2,472,627%. And the S&P 500, by comparison, has only returned 15,000% in the years from 1964 to 2016. And this is a logarithmic scale, by the way, so it's not a uniform scale on the vertical axis on the left-hand side. If it was just a regular scale, Berkshire Hathaway would be off the chart. So from that chart, you can see a huge gap, how much more successful Warren Buffett is than the market in general, a huge amount. When he took over the company in 1964, the stock traded at $12.34. And as of August 18th, 2019, Berkshire Hathaway's stock was at over $300,000 for one share, okay? They don't do stock splits, at least not on their A-class stock. They just let it rise. And right now it's $300,000 just for one share. So that means if you'd invested $10,000 in the stock at $12.34 a share in 1964, when Buffett took over, you would now have over $243 million. Okay, so that's a little bit about the background. We're now actually going to get into this step-by-step guide of how to follow Warren Buffett's investment strategies. So step 1 is buy companies, not stocks. So Buffett views buying the stock as a way to obtain partial ownership of a company, and he's looking for, various traits in that company, such as quality, competitiveness, growth prospects, and values. Buffett studies the intrinsic value of that company, and he never wants to overpay for the stock. He always wants to buy it at a good price versus the intrinsic value. And thus he sees market volatility as a good thing because it means that he can get stocks at an undervalued price, but actually the underlying investment is sound because he's investing in the company itself, not just trading the stock. And so it can be said that Buffett invests for the long term, and he does not care about day-to-day price fluctuations that are based on speculation. He's looking at intrinsic value in the long term. Step 2, identify companies with what Buffett calls competitive moats. So Warren Buffett has said that investors should focus on investing in companies with a durable competitive advantage in their respective industries. And he's also sometimes called this a competitive moat. So a moat, it's something you build around a castle. It's like a lake around a castle that people have to get across if they want to attack the castle. So basically what he means by this is kind of a buffer zone, certain assets, attributes of the company that mean that its advantage in the industry cannot easily be taken away by other companies because it has so much going for it. Now we're going to put a chart on screen now showing 2 companies. One is Coca-Cola, or KO, and also Macy's, or M, the ticker symbol for Macy's, and Coca-Cola is one of Warren Buffett's long-term investments. And you can see here, Coca-Cola has risen nicely over the years while Macy's has declined. This is because Coca-Cola does have a competitive moat. It has a very strong brand, so that is intangible assets, the intellectual property, the branding, the logos, etc., the flavors. Has cost advantages due to its strong relationship with retailers and vast global distributors network, among many other advantages. Now, Macy's, on the other hand, it is a leading department store. No one's going to take that away. No one's going to deny that. It's a big name, but it does lack a lot of these advantages, or lack a competitive moat. So Macy's has unsustainable intangible assets. It has a lack of cost-based advantage when you're competing with both e-commerce and also discount retailers. And it's difficult to generate economic profits. And you can see from the market price, Coca-Cola has risen nicely over the last 5 years and Macy's has declined. Step 3, buy companies at a discounted price. So Warren Buffett does not like to overpay for his stocks, as we've mentioned earlier in the video. He only buys companies when the price is below the intrinsic value. And thus, when the stock market is in crash mode and other people are selling, he views this as a buying opportunity. And there is a famous quote from Warren Buffett talking about we are greedy when others are fearful. Okay, I'll tell you that quote later on in the video because we're going to go through some quotes. But basically, what he means by this is when the stock market is in crash mode, everyone else is selling off, that's when he buys, because the value, the price of the company is below its intrinsic value. Now, you may think that, with such a successful record, Warren Buffett is an expert in all industries. That is actually not true. He is not. He's never really invested in the tech stocks, for example, Facebook, Alphabet, which is the parent company of Google, or Amazon, those huge tech stocks that have had massive growth over the last decade or two. He is in Apple now, that is more of a recent thing. But basically, Warren Buffett, he really preaches that you should invest in what you know. He did invest in IBM a long time ago, and he actually lost a lot of money on that, and he has admitted that that was one of his mistakes. And so Warren Buffett has said, never invest in a business that you don't understand. So if you are looking at a certain company to invest in, you should ask yourself 2 questions. Do you understand what this business does? And do you understand how it makes money? Step 5, invest in companies with trusted and capable management. So Warren Buffett sees the management as key to any successful company, and he wants to invest in companies whose management is capable and can be trusted, and he also wants to see management looking at the long-term future prospects for the company rather than the short term. All right, guys, now I did say that we were going to have a case study later on in the video, so here it is. We're going to talk about one of Warren Buffett's most successful investments, and that is Geico, the car insurance company. I'm sure a lot of people use them. I actually have my car insurance with Geico. They're really easy. Their price was lower than what I was getting with a certain other company previously, which is why I switched to them. And they use a little gecko as their mascot because it sounds kind of like Geico, although it has nothing to do with it. Anyway, very cool branding concept actually, because it's a gecko, not a Geico, but it really does make you remember just because the word is so similar. Anyway, this company has existed for 80 years. It made its money by directly selling car insurance to customers. So you don't have to go through a broker with Geico. It's a direct thing, and thus they can, sell it at a lower rate. Now, Warren Buffett bought into Geico back in the 1950s. He put 65% of his then fortune of $20,000 into the company, and he got very, very excited about it. I'll read you out a quote that Buffett wrote in the Commercial and Financial Chronicle back in 1951. At the present price of about 8 times earnings as of 1950, referring to Geico, a poor year for the industry, referring to the auto insurance business in general, it appears that no price is being paid for the tremendous growth potential of the company, also referring to Geico. So you can see from this quote that he's following his strategy of buying the company at a discount because the entire insurance industry is having a poor year. Thus, even though Geico has good prospects, it's been brought down with the entire industry, and thus the price of the stock is below its intrinsic value, so he's picking up a bargain. Buffett acquired another big stake in Geico in the 1970s, and then in the 90s, he bought the entire thing, and now Geico has a value of $30 billion US. So a very successful investment for Warren Buffett. All right, guys, so that is our guide. We're just going to recap those 5 steps again. So step 1 is to buy companies, not stocks. Step 2, identify companies with competitive moats. Step 3, buy companies at a discounted price. Step 4, invest in what you know. And step 5, invest in companies with trusted and capable management. If you follow these steps in investing, perhaps you can be as successful as Warren Buffett, or you could just let Warren Buffett do it for you and buy Berkshire Hathaway's stock. You don't have to actually spend $300,000 to buy one share, because you could buy their Class B stock, which is around $200. So the average person can actually invest in Berkshire Hathaway and basically let Warren Buffett invest your money for you. And to finish, to cap it off, we're just going to give you 3 quotes from Warren Buffett. Number 1, we simply attempt to be fearful when others are greedy, and to be greedy when others are fearful. Price is what you pay, value is what you get. Rule number 1, never lose money. Rule number 2, never forget rule number 1. So the first 2 quotes that we just mentioned, they're talking about getting companies at a discounted price, so being greedy when others are fearful, utilizing dips in the stock market when everyone's selling off to get companies at a good price, a price that is less than its intrinsic value. And then that final quote, rule number 1, never lose money. Rule number 2, never forget rule number 1. You can actually see that going back to Benjamin Graham, Warren Buffett's teacher in The Intelligent Investor, which is sort of the quintessential guide to value investing. He wrote that book where basically he talks about, to be an intelligent investor, at a minimum, you have to protect the capital at all costs, and then you want to make money, obviously, on top of that, but at a minimum, you have to protect the capital. So that's kind of what Warren Buffett is talking about. Never lose money. All right, guys, I hope you have enjoyed this little guide to investing like Warren Buffett. Please leave your comments below. Subscribe to the Business Shifu. We'll have more investing and business related videos coming up in the next few weeks. We'll see you next time. Bye-bye.